We're in our 11th year of operations now. We're the largest green bank in the nation. The capital from this important source of funding is going to have huge, huge benefits across the country, including New York State.
Your trusted source for information on the energy transition. This is the Insider's Guide to Energy podcast. Welcome to another edition of the Insider's Guide to Energy. I'm your host, Chris Sass, and with me is my co-host, Jeff McCauley. Jeff, what do we have happening today?
We are thrilled to be joined by Andrew Kessler, the president of the New York Green Bank. And for those of you who don't know, the New York Green Bank is one of the oldest green banks in the country. It's been around for over a decade and has deployed over $2 billion into clean energy assets. Andrew, welcome to the show. Tell us a little bit about the founding mission of the New York Green Bank.
Sure. Thanks, Jeff. I'll answer that in a second, but let me just say this is a great opportunity to talk about something that I think has been in the press a lot. There's a very important element in the Inflation Reduction Act, $27 billion greenhouse gas reduction fund. And so I think this is a very timely discussion to have because I think a lot of folks are asking themselves, what is a green bank? How do I think about it? What does this mean to my state? How could this help achieve, various clean energy objectives? And we're, as you mentioned, the oldest green bank, not quite the oldest green bank, but one of the oldest green banks, and certainly the largest. This funding, this $27 billion of greenhouse gas reduction funding, which we're going to get a piece of, and we can talk further about that, is going to be a very significant shot in the arm for New York State and other states to advance their clean energy goals. Now, let me tell you a little bit about us. Look, we're all different. Every green bank is going to be set up slightly different to achieve, obviously, certain priorities that make sense for their location, their geography, their mission. But we all have a very common theme, which is market animation. We're all set up to really animate private sector capital to fund our various geographic areas of responsibility to fund that energy transition. We're a $1 billion state-sponsored investment fund. We're the largest in the nation, as I mentioned, and we've been very active. And we're really proud of that. We've done $2.3 billion of transactions with our $1 billion. So we've recycled our capital once already. We've done over 130 transactions. And our core mission is to identify and address funding gaps, as I mentioned before. That's our key mission. There's no question that public sector capital alone isn't going to fund the energy transition anywhere, including New York State. So that's critical for us to crowd in the private sector capital necessary to do that. And we do that with our very flexible capital. And we can hopefully talk a little bit more about what that means. And we work very hard and closely with our colleagues at NYSERDA. We're a division of NYSERDA. And we are hand in hand working to advance the goals of the Climate Leadership and Community Protection Act, which was passed in New York State in 2019.
Just to give us some examples, you mentioned 130 transactions, over $2 billion. Where might somebody have seen a project that you financed or benefited from one if they're traveling through New York State?
Well, we're going to see examples of that, throughout the state. As you drive through the thoroughfare, we will have done community solar projects. As you drive through, Buffalo, New York City, you will have seen buildings that have gone through investment from New York Green Bank that have achieved energy efficiency and building electrification goals. You will see, and hopefully more so over time, examples of energy storage assets that are being built to ensure that we have the flexible capacity for this renewable energy that we're all bringing on. So there are various examples, and it's really fun as we travel through the state, visiting with different borrowers and meeting with different stakeholders, to take the time to peel off the side of the road and go see something we did. We've been talking about this, and maybe we probably should at some point, but put signs up, funded by, to really showcase the achievements that we're making.
We dove right into the topic here. You started talking about $1 billion, 130 projects. Let's back up a little bit and start for everybody to make sure we all know what a green bank actually is. I know that you're the oldest, but what exactly is it? Just like the name sounds, or is there more to this?
Well, this is great because maybe I'll do a little myth busting here today. There's a lot of misperceptions about what a green bank is, and again, as it's coming up in the press more and more, this is a great opportunity to maybe clarify some of that. So one myth is that we're a bank, and we're not a bank. And the name green bank really originated from the first green bank in the world, which was the UK Green Bank, and the name kind of stuck. We're actually an investment fund. We're a state-sponsored investment fund. You can't come in here and open a deposit account. We don't take deposits. You can't start a checking account. We're not going to give you a toaster if you come in and bank with us. We're an investment fund. We're typically focused on institutional type lending, anywhere in the $5 to $100 million per transaction range. We've done smaller and we'll do bigger. It's all about whether whether that intervention leads to market animation. So that's one important myth. Another one is that, well, you all compete with the private sector, don't you? No, no, we do not. In fact, we're explicitly set up to avoid that. And that's really uh, takes a little retraining. All of us here at New York Green Bank come from the private sector, and we all historically, we thrive on competing. And coming here and understanding the difference in the mission, which is in fact to crowd in private sector capital and not compete against their interests, is a different way of transacting. It takes some getting used to. Back in my private sector days, it would not feel good when, as we call it, a deal would get done away from you. That was a source of great disappointment, to say the least. Here, it's a victory. We celebrate that. We can use our scarce capital and scarce resources to apply them where they better belong, in areas where there are true funding gaps, where the private market, for whatever reason, and there are various reasons, is just not stepping in to fund. Another interesting misperception you hear sometimes, kind of two sides of the same coin, is on the one hand whether green banks only do subsidized capital. Or sometimes you hear the opposite. Green banks only do market-based lending. It's funny, you hear both, two sort of extremes. And we hear that a lot. The truth is, the green banks do both. And it really it's about market animation. There are use cases where the financing environment for that use case, it has historically been supported by subsidized capital, by what we call concessionary capital. So of course, when we're going into those situations, we're going to utilize a subsidy-like approach to help crowd in some of those subsidies. In market-based lending, we're going to apply market-based and pricing and structures, crowd in the traditional private sector lenders.
Now, the different capital you said you've already had your capital put back to work. Um, are these kind of the same kind of performance that we're seeing from private equity in times of term and performance? Are you gap funding these projects in order to get your capital back, or what kind of projects excite you so that your capital isn't all tied up in one or two large projects?
Well, it's a great question, Chris, and that goes to flexibility. So we're not looking to maximize profits. We're looking to animate capital. And so we will price accordingly. But, one of our key missions is to ensure that we are self-sustaining. And that's the beauty of this program. The principal that we charge for our capital over time has well cleared our cost structure. We became self-sustaining in 2017. And so we're really looking to, as I mentioned before, animate private capital by, well, how do you do that? Well, if you're closing into transactions in cases that can support market-based lending and you're lending at subsidized rates, what are you doing? You're competing against the private market. You're taking what they otherwise could have done or should have done or may have been quite willing to do, and you undercut them. And so we look for pricing and structuring at what we consider to be market and demonstrate those precedents, show them, talk about them, knowledge share with the developer community in New York State and the lender community in New York State and elsewhere to demonstrate, a path towards doing more of that replication, adoption, and scale. On the subsidized side, look, we have a very large portion of our balance sheet focused on extremely concessionary pricing, 1.5%, $250 million community decarbonization fund. I mean, you can see where the treasuries are now. So that is highly concessionary capital. Why do we do it? It's highly market animating. What we're doing with that capital is we're providing community lenders like CDFIs and others, credit unions, an opportunity to either expand their green lending practice or in many cases start one from scratch. So we're greening community lenders through this concessionary capital, getting that ball rolling so that over time they're building a profitable practice that they can then fund themselves through their traditional means. But that $250 million that we put out in anywhere from 2 or 3 to $25 million allocations in New York State to community lenders, and by the way, specifically for benefiting disadvantaged communities, is one of the most highly market animating and catalytic things that we do. But yet it's entirely concessionary in nature.
Andrew, you mentioned two really interesting pieces of information. One, that you are self sustaining as an organization, and two, that you're actually providing a significant amount of concessional lending sub treasury, basically, right now. How are those two things the case?
Well, yeah, that's really the kind of the genius of this program. With $1 billion, right, that we were initially capitalized by, we've been able to recycle an entire turn of that capital. And I mentioned $2.3 billion that we've done. That $2.3 billion funded over $7 billion worth of sustainable infrastructure in New York State. There's a portion of that, Jeff, that was done on market-based terms. And market is market, depending on the risk profile. Some of our loans are in the high single digits. We've been involved in transactions that are priced in the low double digits. And of course, that activity provides us with the income necessary to afford to do tremendous things, within use cases that cannot support market-based lending. As much as I mentioned, a quarter of our fund, $250 million of our fund dedicated to servicing disadvantaged community through a wholesale funding pathway to these community lenders at 1.5%. So it's really, that's the brilliance. And when, by the way, like any scarce resource, you eventually run out of a resource. And, we've put money to work over time and have found ourselves liquidity constrained. So back in, for example, in 2021, we took a portion of our portfolio and we monetized it. We raised cash that way, $314 million, the largest green bank monetization in the world, freeing up capital to allow us to continue the program. Never once asking for New York State for more capital. So that's really the genius of this program, in that it is set up to be self-sustaining, and just once you fund it, pay dividends, for obviously for for as long as we need to. And maybe eventually we don't need to. That's the goal. At some point, we hope funding gaps don't exist in clean energy markets in New York State, and we can bring this capital back for other uses. But for now, there's a tremendous demand for what we're doing.
Where are the users of this capital? Are they solely in New York State, or is there enough to drive $1 billion investment in the state, or are you amplifying through other states?
All of our capital is used to advance New York State sustainable infrastructure. Um, so, um, and it really varies, Chris. It varies by size. That goes back to flexibility. When you're in the gap filling business, you have got to have flexibility. We can be anywhere in the capital stack virtually. The only restriction is just, our sense of mission and prioritization. We're grateful to have the flexibility from the Public Service Commission to be able to deploy our capital in ways that we think make the most sense for the use case. We can be subordinated. We're senior. We can be at a holding company level. We've even done preferred investments. In relation to size, our smallest transaction has been, something in the neighborhood of $600,000. Our largest, as large as $100 million. In terms of different technologies, we are focused on prioritizing the goals of the Climate Act. So naturally, that is a North Star for us. But we've been involved in solar, in wind, in energy storage, clean transportation, and of course, building electrification. And in all cases, we're focused on ensuring that our capital is equitably benefiting all New Yorkers. That is just critical to our mission and at the heart of the Climate Act. We're mandated to ensure that at least 35% of our capital, with a goal of 40%, benefits disadvantaged communities as measured between 2020 and 2025. And we are at this point at 34% with a clear line of sight to achieving our minimum later this year.
This is wonderful. And I just want to keep going back to this point. There's no taxpayer dollars. It's not like somebody listening to this in New York is like, why are you using my tax dollars? And what you're saying is you've already been capitalized. You're break even slash positive, and those profits, the excess cash that you return, gets recycled into more lending on a market rate or concessional rate lending. So this is not an ongoing tax burden in the state of New York. It's self-sustaining.
That's exactly right. And that's what's so exciting about the $27 billion of GGRF, Greenhouse Gas Reduction Fund, that's going to hopefully make its way across the US. There's three portions of that. There's the one portion, the NCIF portion, is a $14 billion pathway meant to capitalize three national green banks, but also meant to capitalize new and emerging green banks, as well as obviously provide New York Green Bank with additional capital to fund our mission. So it's really exciting. This GGRF process has been a great opportunity to bring the community together. We have a lot to share, and we're always trying to make time for folks to be able to put a program that makes sense for them. Not everything we've done here makes sense for everybody, but certainly we have been through a lot that we think we can help folks create that uniquely self-sustaining government program, Jeff, that you're asking about. Because again, you're absolutely right. The initial $1 billion, we haven't asked for more. We haven't needed more. We've monetized when necessary to create additional liquidity. And of course, we're delighted to complement state dollars with these federal dollars to enhance the mission.
This is really fantastic. So going back to the crowding in, or you say animating markets, how do you know? This is always a counterfactual question, right? Do you have to go out and ask 5 banks and they all declined the deal in order for you to justify? Or what's the easy test to know that you're not displacing private capital?
Yeah, it's a great question. It's not an easy test. There's not a rubric that you just sort of, we haven't AI'd it yet. There's no framework that exists where you can just sort of punch in some information and it says you're done. We look at a lot of factors. We look at the level of activity within the space. So we're seeing what else is getting done in a particular technology, in a particular sector, and even within the sector, in a particular part of the finance value chain. Let me give you an example. Community solar. Well, you have a certain segment of the community solar development market that is truly developing. It's achieving site control, getting permitting, getting in the utility queue, preparing the asset for construction, what we call, NTP. And, that requires capital. And there's a whole business model associated with just doing that and selling it then to an operator that is going to construct and operate. That is an ecosystem that needs funding. Of course, you have the construction that needs funding. And then the construction is typically taken out by permanent term capital. So, even within a segment, you could have funding gaps in various particular areas. And so, we look at that very carefully. We look at pricing. I mean, there's no better way to determine whether there's competitive tension when you start seeing spreads start to compress. So we look at proposals that come in. Maybe we can talk about that. I think is in terms of some of the myths. How do I access this?
Yeah, where's the
Yeah,
door, right? Because it sounds great, and then also you do decline deals, right? You're not just taking everything. You
we
don't have
decline
to. Your
deals all the
mandate is
time.
not to do a bad deal.
We dec
So yeah, who
yeah,
who should approach the New York Green Bank? Where's the door? What should they bring? Somebody's listening to this. Say, I've got a funding gap. Fund me. Where should they go to find
sure,
if New York Green Bank's a fit?
sure. I'm just going to finish the last point real quick, and that's the most important point, which is stakeholder engagement. Full on. We do roundtables, we participate in conferences, we talk to the market all the time. And so, having our ear to the ground, gives us and some of the other elements I talked about, gives us a totality perspective on whether we're making progress on a funding gap or whether we've actually closed it and we can declare victory and move on to something else. Back to your question, how do you unlock this capital? There is a misconception that it's overly complicated. It must be bureaucratic. It's a state program. How does it work? We try to make it as straightforward as possible. Again, we all come from the private sector, and we're trying to animate private capital. So we're trying to mimic what a private investment fund, could do. And so we've got a simple portal where we ask folks to submit a proposal into. Anyone can do it. You don't need to know anyone at New York Green Bank. You don't have to have a special relationship. It's open to everybody. We score it once a week, and you're going to know whether it's past eligibility or not. And eligibility is straightforward. It's not diligence. We will get to that if it passes eligibility. Does it have the ability to reduce greenhouse gases in New York? Does it have elements that would enable us to remain self-sustaining, right? And what we've been talking about, I think thematically throughout this talk, does it have a significant potential to animate private capital? And if we pass all three of those criteria, you're well on your way to getting a deal team, and then you're off to the races in a very straightforward manner. We'll set up a data room, and it's a simple two-step approval process. Look, I think we've closed transactions as quickly as 8 weeks. Quite often, it takes a lot longer, and that is often because we're dealing with people that are coming to us because they have a project that's hard. That's why there's a funding gap there. And so either they're challenging to get things transaction ready, or we're doing a lot of diligence, or there's some other factor, going on there. So we roll up our sleeves, we take the time to get this right. But ultimately, Chris, accessing us is pretty straightforward. I'm going to give us a little info at greenbank.ny.gov. We do check that daily, and we will get back to you. So we're not hard to unlock. Just reach out to us, and please come ready to transact, because we'll take the time and effort to engage with you.
Let's assume that we qualified and we get past your data room and you give us the money. What kind of investor are you? Are you a hands-on investor? Are you going to be in my company, or are you loaning me money and sitting on the sidelines? What model does your organization have?
Yeah, it's a great question. So, what kind of a capital really are we? Are we equity, where we're on your board telling you what to do? Are we more lenders? A typical capital stack in a clean energy transaction, it can be anywhere from 10 to 20% equity. And then maybe there's, another whatever 30 to or so percent that could be tax equity oriented in certain cases where tax equity is relevant. And then the balance is debt. And when there's no tax equity, obviously the capital stack is highly debt heavy. And debt and leverage is very important to making the equity returns work for the equity investors. And so when we think about how we use our scarce $1 billion, sounds like a lot of money, but in the scheme of things, to try to achieve the energy transition in New York State, it isn't. That's why we have to be very strategic about how we use our capital. We typically, Chris, tend to utilize our capital to animate the heavy lifter of the capital stack, debt financing. So when you get capital from us, very likely it is going to be in the form of a traditional project loan, project financing, where we're a lender into the project. Rarely are we a lender to you as a company. We're looking to make sure things get built. So we're going to create a special purpose vehicle to house a project that you're trying to build, and we're going to fund that project and get out of your way.
Yeah. Andrew, this is fantastic. I'm curious also where you see the market gaps going. So if you could give us an example of a gap that you feel like you've been doing this for over a decade, what's a gap that's been closed where you were an early leader, you were in there, you're funded, and now New York Green Bank is no longer needed? And then what's a hot up and coming area where there's a lot of gaps that you're seeing a lot of excitement and a market that needs animation?
Well, yeah. Thanks for asking that. I would say generally solar is an area that we feel has been well addressed. There are still funding gaps within certain components of solar. But when we started back in 2013, and you looked at our portfolio up to around 2020, and by the way, all of our information like that is publicly available. So it's probably the most transparent investment funds out there in terms of data that we provide to exactly how we're using this capital. But we were highly concentrated in solar, both residential as well as community solar. Over time, that sort of fast forward to now, and that diversification is a completely different picture. Solar is around 40% total of our portfolio instead of approaching 80-85%. And why is that? Because we recognize that the solar gaps that we had been seeing were starting to close and shifted our focuses into other technologies, other use cases. In the residential solar market, a lot of the resi solar companies are now big public companies. Public companies. So these are folks with sophisticated teams, publicly public company management, able to access equity, able to access and unlock different portions of the financing market. On the community solar side, that was a brand new model in 2015 in New York State, and it was a head scratcher. A lot of the banks didn't really know what to make of it. The traditional solar lending model was you had a contract, PPA and offtake, with one or more off takers. You diligence that. You say, well, how long is that contract? And Are they money good? And what are the ounce? And, okay, maybe I can lend to that. This is a subscription-based model that was also supported by a new program called Meter that was launched by NYSERDA. Today it's not that complicated. In fact, we have the most robust community solar market in the country, even though New York State isn't, the number one solar resource. We're not Nevada, we're not, Florida. But what we've done through the VETR program and through our intervention is we've created a very easy to work in model for developers and financiers. But it wasn't so in 2015. We put out the first transactions back in 2015. We shared them entirely transparently with the market. We pulled in other lenders into our third and fourth deal. We pulled in others so they sort of teach them to fish, help them understand how to think about this. And it's not that they can't figure it out themselves. They have a big market opportunity. They have the entire US. We have to convince them to spend the time to understand what VETR means and how to model it and how to structure it. We have to help them understand how the subscription model works with the community solar. And once they did, they understood that the opportunity made sense to finance. And as I said, we can see the results. But that's one where I would consider, mission accomplished. Generally speaking, we still support community solar in relation to interconnection deposit lending, which has historically been equity finance, and we'd like to see that scarce equity be deployed in better uses. And we think that that's a debt financeable funding use case.
I think we have time for maybe one more question, and then we'll go into your personal journey. When you're talking about the trend, you talked about community solar as an example of something that's kind of ridden its cycle. That probably means that on the forefront, you see other technology, whether it be offshore wind, whether it be EV, charging stations. What trends are you seeing in New York State coming? What should we be expecting, and what's hard to get done in New York that needs some help from someone like a green bank?
Yeah, sure. I mean, look, our priority areas today include building decarbonization. We have got to decarbonize New York State's building stock. We got to do it, for the residents, but we have to do it, for our climate goals. And that's a huge focus of ours. We have two specific targets on that. We have a $100 million building decarbonization focused on disadvantaged communities goal, of which we're about halfway done. We have a $150 million goal for green affordable housing investing, of which we're about halfway done. The second big category is in energy storage. We have got to make sure that we have the flexibility in the grid to be able to manage the additions that's coming from the offshore wind and some of the onshore resources. And so we're very focused on that. And that's just starting to really, develop a level of maturization that, is debt financeable. There's been a lot of, it's a highly variable cash flow model, and it's been a challenge for many lenders to be able to finance. And then the third big category that we're focused on is clean transportation, both on the vehicle side as well as on the charging infrastructure, because they're kind of a chicken and egg, right? We got to tackle them, together. And it's a very complicated and marketplace. You've got the commercial fleet side, you got the residential side, you've got school buses, you've got transit, you've got airport stuff. There's a lot to do in that sector. So we're looking carefully at how to prioritize and make progress there. New York State, through NYSERDA's leadership, has issued a clean transportation roadmap that is available for folks to see to help folks understand our prioritization, where we think the low-hanging fruit is, and how we're going to achieve our longer term goals in that sector. But we've got a lot of effort, time, effort focused in on animating that space. And then beyond that, obviously, are even newer technologies that could be really important. Hydrogen, as an example. So clean hydrogen, of course. So there's a lot going on that I think is going to keep us very busy, which is why having access to some of the greenhouse gas reduction fund capital is going to be as I mentioned earlier, it's just a huge shot in the arm to be able to continue to do what we need to do in some of these newer areas.
Yeah. And Andrew, maybe last question is a different kind of capital, which is the human capital. So you mentioned that folks on your team, you personally have had a background in the private sector. With the influx of new funds into green banks, there's going to be a lot of hiring out there. Based on your personal journey and the teams that you've mentored, what advice do you have to listeners out there who are maybe earlier in their career and looking for a way to get involved deploying impact capital?
Look, um, there's a trade-off. Everything has a trade-off. Life is just full of trade-offs. You wake up and there's a trade-off. This is public service. You know, what you get out of this is just some incredibly rewarding sense of impact that you're making with this capital. You know, it's an opportunity to do first of its kind stuff. You know, we think of about ourselves like a financial innovation lab. We're developing new recipes. They don't all, lead to, uh, the demand we'd hope, but many do. And so it's very innovative. It's very exciting. It's very cutting edge, and it's very impactful. But you're not going to, achieve the same compensation levels in this business that you would in the private sector. That being said, in the private sector, you'll certainly achieve higher compensation levels and maybe not have the impact that you want to have with your career. But you don't have to choose one or the other. You have hopefully a long career. Consider public service for some time. It's a great complement to your private sector work. It'll pay dividends when you go back, if you go back. And in the meantime, you've obviously added to your skill set, to your experience set, and hopefully, you come home feeling pretty good about what you've been able to do with a finance background.
Well, Andrew, this has been a fascinating conversation. I understand a bit about New York Green Bank, quite a bit more than I did at the beginning of the conversation. I appreciate that. I enjoy seeing the capital at work and all the things that you're working on, and some of the vision you come with, and your call for public service and getting people engaged. I want to thank you so much for coming on Insider's Guide to Energy. It's been a pleasure having you on our show today.
Thanks so much for the interest, Chris and Jeff. It's really great to talk to you all. Thanks again.
Our audience, if you've enjoyed this content, take a second and hit that like button, add a comment, ask a question, and subscribe to us on YouTube. We'll see you again next time on the Insider's Guide to Energy podcast. Bye for now.